So in this tutorial, we're going to look at, well, for some of you, maybe the most important of any of the tutes that we do here, and that's deductions. And so we're basically going to kick this off by going through and looking at whether or not you can deduct your fees, your university fees, including HECS, textbooks, compulsory student union fees and such like. That's the first question we're going to look at. Now, for each of the 7 questions that are there on the screen, we're going to go into some of them in a little bit of depth in order to be able to answer them comprehensively. So starting with self-education expenses, really the starting point here is that the government don't really want you to be deducting these wherever possible. So we look at really starting with the 2 limbs of 8-1 in the 97 Tax Act. And under that first limb, the Commissioner has actually released quite a lot of statements on this, and the courts have upheld this position. And basically, you can deduct self-education expenses if there is this really strong connection to what you're doing. But you know, there's this appreciation that all of us from time to time, you know, may go on to do things unrelated to what we're doing, and we get that sort of benefit that comes from education. And so basically the Commissioner has said, look, you can't deduct these things if you're doing it to get another job, or if you're using it to somehow open up a different area of income earning capability or capacity, be that as said in a new sort of industry or in the a related industry, but really in terms of new employment. So here in this problem, if we've got, say, somebody doing an accounting degree and you're working as a bookkeeper or in an accounting firm, there's a really strong connection between your current employment and achieving this particular education goal. However, there's another very large catch here, is that you can't deduct things that relate to the HECS system. And as you're aware, most Australian citizen undergraduate students generally put their fees on HECS, and there is a very specific rule in Division 26 that says, look, you can't deduct these things. You can't deduct the amount that you borrow through HECS, you can't deduct the amount that you're repaying through HECS, and you can't deduct the amount, essentially the interest, or the they call it the indexation amount that they apply to outstanding HECS balances each year. All of those 3 things are expressly disallowed as deductions. Now, a more interesting question is to look at whether the interest on a loan that you might take out in order to repay HECS deduction, there, at least arguably, that's not going to be deductible either. Even if the Commissioner can't catch it under 26-20, essentially it's still of a private or domestic nature. The HECS debt is very much associated with the person. Now, there's some other curious things to do with self-education expenses, and one of them in the old Tax Act is this $250 rule. You see that there are things in relation to self-employment, such as childcare expenses or the cost of driving from your own home to get to the educational institute, and they're not normally deductible. However, there's a rule that says the first $250 of self-education expenses in any given tax year isn't deductible either, and the courts are quite happy for you to apply your non-deductible things such as childcare and travel to and from your home towards this $250. It's a little bit of a quirky rule or system. And if a question like this does come up in your assessment, you really just need to note that look, these otherwise non-deductible things can be applied towards this first $250, and then the things beyond there are going to be deductible. Another thing to note here is the student union fees. If there is a student union fee that's paid through the HECS system, it won't be deductible. However, if you rock up to the student union and pay cash, then it will be deductible, assuming again you've got this nexus between your current employment and the particular course that you're doing. Textbooks are deductible, and just note that if they are less than $300, you can write them off in the current year. Textbooks that are more than that, and that's quite rare, you are essentially assets that need to be depreciated and written off over several periods. So in this problem question, the $250 rule is offset with the $250 worth of childcare that the taxpayer has accrued in this period. So assuming that the student fee is paid via cash and the textbooks relate to the particular subject that the taxpayer is undertaking, that component, those parts are going to be deductible. Things that relate to the HEC system won't be. The next thing we look at is the receipt of OS study. Now, this really flows from a case from about 5 or 6 years ago called Anstis. And there the taxpayer went to the High Court and actually won. She was allowed to achieve a deduction because she argued in that case that, look, hey, I'm doing this course to get this particular income stream. And the High Court was happy to entertain that. However, Parliament was not. And so 26-19 was inserted into the tax legislation at that point in time. And from that point onwards, from the 2012 tax year forwards, no deduction is allowed for these, what they call rebatable benefit schemes. And then next thing, which is a question that comes up quite a lot, is the deducting of fines and penalties incurred throughout the life of a business. So here, for example, the example is a brothel receiving fines, but similar things apply, particularly things like professional drivers who from time to time are just going to incur fines. That's a regular part of their business. However, you can't deduct them. So while these are involuntary but necessary expenses, you still are disallowed these fines and penalties as deductions. It's under 26-5. And that refers to fines and penalties, so a stated amount by some form of government or quasi-government entity fining a particular person. There's also another section, 26-54, that disallows the deducting of expenses, where you're doing basically a criminal act. Now, it's a little bit narrow in that you do have to be convicted of what's called an indictable offence, a pretty serious offence. But the overall public policy reasons for this are that we don't want to give tax benefits to people undertaking naughty criminal behaviour. Now, the next thing to look at is pre-business expenses. So here we've got a feasibility study where a taxpayer or multiple taxpayers are coming together to determine whether or not a particular business venture is going to work, whether it's going to fly. And the default rule is, unfortunately, for those seeking to go into business, is usually no. And it kind of makes sense from what we've learned about this connection between the activities of the taxpayer and the particular business. Because really, if you are making expenditures in order to start some form of business, then unfortunately, by definition under the two limbs, you're not actually earning assessable income and you're not carrying on a business because you haven't reached that point. And so the courts have been reasonably hard in terms of this point, these pre-business expenses. Now, it's much, much easier, of course, if you're already in a particular business and you're just looking at expanding in some way, having a particular project, for example. And in fact, the Division 40 actually goes and expresses this. It talks about project amounts and deducting those over the life of the project, particularly in situations where there's a planned project and it doesn't go ahead, as is the case here. And so we're not really given enough information to answer this fully for this particular question. But I think in terms of future assessment that may arise in this area, just leave in the back of your mind this idea that, unfortunately, just the way that 8-1 is written, you can't really deduct things that occur prior to the business commencing. And so that's something just to leave on the back of your mind. Now, the next thing we'll to look at is the keeping of guard dogs. Now, this may come as a rude surprise for those that do have very, very loved pets who form part of the family. Unfortunately, in Australian law, pets are items of personal property. Now, you can also look at items of personal property as things which can aid or assist your business in some way. And again, this definition of outgoings that are necessarily incurred in carrying on your business means that you can deduct the cost of guard dogs as a part of your business, and not only deduct the cost of acquiring the dogs, but also the costs of food and veterinary expenses. And and also note that because they're items of personal property, they are depreciated, assuming that they cost more than $300 to acquire. It's one of those slightly unfortunate things when putting on our tax agent hats that we have to look at animals in this light. And so the next thing to look at is the deductibility of food. Now, food is something that I guess all human beings are going to go and eat. So as a result, these are the sort of areas that the Commissioner really likes to rein in, to have quite a tight control over. And so this deduction is specifically disallowed under 35-5. And that kind of makes sense. If businesses were able to go about doing, having lunches and doing these things, then all of us would have our own businesses, and we would have our own entertainment expenses. And also note that that benefits given to employees can fall under the fringe benefit regime as well. Now, the next bit's quite interesting. Home office expenses. Again, pretty much all of us live in a house that we either rent or own, and pay. Most of us pay mortgages on such things, and it's not uncommon for people to work from home. And so I guess that begs the question of that. Well, if we're working from home and I've got these outlays, can I deduct those? Now, the example here where we've got an accountant who has a home office for 20 hours a week for 90% of the year, so 10% of the year presumably uses it for private purposes. And that particular accountant has very carefully worked out that the percentage of his rates, interest, insurance, electricity, and house cleaning comes to $10,000 as a fraction of all of the expenses that she or he may have. Now, when dealing with home office expenses, we've really got to differentiate them between two different types. You've got running expenses. Now, those are the things that you are directly using or consuming by being in that space. So think of the example of an air conditioning unit. You've got a home office which is clearly delineated in a house. No one else goes in there. It's not used for any other purpose. And when you go in there, you flick the air conditioning on. Now, assuming that you can go about calculating that, that's a running expense. Similarly, office furniture that you might want to have in that office, or the cost of cleaning that particular office. These are things that you wouldn't incur if you weren't running the business in that particular space. Now, there's two ways of going about this. You can make a claim based on the actual expense, if you can record this, and again, as the taxpayer is obliged to substantiate these claims, and to do so, usually one keeps a diary of such things and records receipts and cleaning invoices and such like relating to that particular space. Now, the Commissioner also gives the taxpayer the option of just claiming a flat 45 cents an hour. And again, this is something that you can have or record in terms of the time that you occupy the space and you're working in there. All of these diaries and electronic records and receipts that you have are used to substantiate your claim. Now, phones are a little bit trickier. basically for claims of up to $50, the ATO can accept claims for where a person at home is required to use his or her phone as part of for work-related purposes. They actually have different rates. So landline is you can deduct 25 cents a call, mobile 75, and SMS 10 cents. Now, while this is still the practice direction issued by the ATO, I would just make note that I guess in this day and age, this differentiation between landline and mobiles is it's really old hat, and really it doesn't matter much because the deduction is allowed up to $50, and as most of us are aware that that contemporary mobile and phone contracts are often vastly in excess of that over the course of a year. If, however, you want to go over that $50 limit, then you need to keep records. You've got to keep a solid record over a 4-week period in a diary, recording phone calls that are made and the cost of those calls in order to make and substantiate that claim. Now, those are running expenses, things related very much to that space that you wouldn't incur at home if not for that office. Now, the opposite of that are what's called occupancy expenses. Those are things that really are attracted to the entire building. They're going to be there even if you didn't have your this room allocated to the home office. So such things as rates, insurance, interest in repaying the mortgage, the connection, the continuous connection of electricity as opposed to the marginal cost. And for those that don't own their own homes, rent, the rent that you would pay. All of those expenses carry on regardless of whether you're doing anything relating to your business or not. Now, the Commissioner will let you actually deduct a fraction of those if and only if the area that you've allocated to the business is identifiably separate from the general living area and from other spaces. So where a home office is established, it can't be used as a bedroom for over the summer period, for example. The Commissioner takes something of a hard line on this, and that kind of makes sense because we all live in houses, and we would all love to claim tax deductions because that's more money in our pockets at the end of each tax year. And so there are a few gotchas here in terms of allocating space for doing this. The first sort of gotcha is trying to determine what the fraction of space is. Now, where you've got the office, a pretty simple way of doing it is just to draw a floor plan. If you've set aside an area, this is going to be the home office. Draw a map of the house. It doesn't have to be perfect, but identify what that fraction is, and that's the percentage of these occupancy expenses that you can claim. Now, for those renting who have this set up, that's not a problem. That fraction of that rent isn't problematic. It is much more problematic for those who own their own home. And the reason for that is that if you set aside a fraction of your house to be for a business or business purposes and you want to claim this deduction, you actually lose what's known as the main residency exception for capital gains tax. So for example, you set aside 20% of your house and you make all of these claims, all of these deductions over the course of the time you run your business there. When you go to sell the place, 20% of your house is going to be liable for CGT. So that's something that, particularly when advising clients who are setting up these sorts of arrangements, to be very, very careful about this, because this is sort of thing that, when giving advice, can come back and haunt a person many, many years later when that house is disposed of. And so here, to answer this particular question in terms of what can be deducted, well, if the taxpayer's using the thing for 20 hours a week, and it's unclear here whether they're using it for other purposes in that time, and where it talks about 90% of the year, whether or not Auntie Ethel is coming and staying for that remainder for that 10%. Because if that's the case, you're not going to get any deduction for that component at all. And so a simple piece of advice, if this was a taxpayer coming to you, would be to say, well, look, just if you've got this thing, you've got this area, just don't use it for other purposes, or at least make it very, very clear that this component of the house is an actual home office. And a helpful tip for this in this day and age is digital photos. And the next thing we'll look at is this idea of protecting your business and or your industry from potential change. This is something that can occur particularly for large industries and for large businesses who actually have the ability to change the environment that they operate in. And this is something of a complex issue. Again, we start from first principles and then sort of examine each of the arguments for and against in this particular case for deducting these things or not. So when answering this style of question, where the examiner is really wanting you to have a discussion, what you're being asked to do is to explain and describe cases that are similar, that really you can look at the underlying facts of those cases, extract out the principles, and compare and contrast this current case to the facts in order to construct an argument. This style of question is not one that lends itself to a hard and fast answer. And so here in the discussion to do with deductions, start with how 8-1 of the ITA 97, how it actually works. Because fundamentally, you can't deduct things that are capital in nature. It has to relate either to the gaining or producing of income directly or something that's necessarily incurred as part of a business. So in this case, we're launching an advertising campaign to prevent certain political things which may be afoot. Really doesn't relate much to the first limb at all. It's not really incurred in gaining or producing the income. What we're looking at here is whether it's necessarily incurred in carrying on the business. Because clearly doing and running this campaign is going to have some form of benefit. It is actually going to have a positive long-term impact. And I guess we can take from that will, in some way, that advantage is going to increase income streams. Now, when we think about this managing or maintaining potential future income streams, well, doesn't this sound a bit familiar? Doesn't this sound a little bit like when we were talking about this fruit and tree analogy, when we were talking about the income side of things? Here, though, we're looking at deductions, and we're trying to determine whether things are of a capital nature or not. In other words, is the structure impacted or affected, or are we actually going to increase income streams as a result? And so it can be helpful to just have a look at the cases. And again, describing cases very briefly in terms of what the particular facts were and the principle that came from that is a very helpful way to get your head around this style of question where we're trying to make an argument in relation to a set of facts given to us. So when looking at Snowden and Wilson, for example, there you had something similar where, look, the entity spent a large sum of money advertising after there was a royal commission that had been set up in order to look into his activities. And in that particular case, the courts were actually happy to say, yeah, this is allowable as a deduction. It is necessary if that business is going to carry on earning income in the same way it had done before. However, flip side of that, in Broken Hill Theatres, this legal fees and campaigning against the grant of a license to one of your competitors was actually held to be structural. It was capital in nature and not allowed as a deduction. And so when answering one of these discussion type questions, it is always helpful to start with first principles and to just make note that we're not really talking about the first limb here. So just you want to make note of that when doing the application step. The first limb is probably not going to apply. We're really talking about the things that are necessarily incurred for the carrying on of a business, and where the taxpayer's activities look quite similar to an existing case. Mention that case, talk about it, and say, look, the taxpayer is if they don't oppose this measures, then look, their business is going to be substantially affected and impacted. However, the flip side of that is that, well, arguably, it's probably going to be capital in nature. And so really we want to look at whether this expenditure is going to be of long-lasting advantage, whether or not you're actually outlaying money to really gain some sort of long-term benefit. And if we think of the analogy, this idea of having out and those outlays are creating something, giving us something solid, something substantial. Because if that's the case, this solid, substantial benefit is going to be capital in nature. And so, when applying the present facts to sort of comparing them with these precedent cases, pick a side. For most of these style of questions, there's not going to be much allocated in terms of their getting the right or wrong answer, because it's about the quality of argument. And this is true of legal argument. When two parties go to court, the only reason they ever go to court is because they disagree about the various arguments that they have. And so my argument here is that, well, looking at each of these two cases, in particular Snowden and Wilson and Broken Hill Theatres, I'd argue it's probably more similar to Broken Hill in terms of this this outlay is really going to give some structural benefit to the entity, to the taxpayer. And so arguably the additional 200% of advertising, that being the extra or unusual advertising for this tax year, is probably capital in nature. Certainly that's the way I would go, but I'd accept an argument either way. Now the final question we'll look at is expenses that are incurred after a business has ceased. And these things can come up. Again, the problem question here, we're looking at advice given by an accountant who then subsequently retires or leaves that business. But advice that's been given in the past can still, I guess, come back to haunt you. Certainly for any listeners that have ever been in business themselves and then ceased that business, there is a certain point of time where one could almost celebrate, because the contractual warranties and statutory warranty periods wear off after a length of time. In the legal profession, a person can't bring an action for contract and tort after the expiry of 6 years. Now, there is insurance for the bringing of claims, and again, most professionals pay some form of indemnity insurance in order to really cover themselves from being sued. However, it's an interesting thought here that insurance cover may actually not fully cover you, and so here the taxpayer has had a look at the policy that they're under and decided to top it up. Look, I've had some clients and they could sue me, and they could sue me for more than the insurance company coverage is for. I'd like to top that up to really sort of protect myself to a higher extent. And the issue there is that, look, if you ceased trading a long time ago, can you deduct that? And again, I've sort of wanting to express this as more of a discussion where several of the cases are sort of listed and explained very briefly. And again, I don't recommend to go too much in depth with any particular case, but just enough to explain the core facts and the principle that came from that. So generally the decision, which way the court went in that case. So the first one to start with, and the starting point when you're applying your legal principles, is Amalgamated Zinc. And there the taxpayer lost. So basically there was a workers' compensation scheme, and the scheme related to its mining activities. It stopped having mining activities, and the court said, well, if you're still paying these compulsory statutory payments to these ex-employees, after you've ceased operating your business, there's no nexus. And so the court said, look, no deduction is going to be allowed for that. And the flip side of that was in this Rompibon tin, there were operations, and there were plans, and this is the important distinctive point, there were plans to resume operating. And so the deduction was allowed in that case because, look, well, sure, we can't operate now, but in the future, you're going to, it's possible that you're going to go and produce assessable income. Then in agency advances, one business took over another one and wanted to claim a deduction for bad debts incurred earlier by the previous entity. And the court in that situation was happy to allow that deduction because there was this, even though it wasn't the exact same business, there was something similar that was carrying on to have that connection. And similarly, in Pacer Pacific, the court talked about this in a bit more depth and said, look, it's really, if there are outgoings that occur after the taxpayer sort of ceases business operations, that doesn't necessarily mean that you can't deduct them. There's no hard and fast rule to say that you can't. And that's really going back and looking at Amalgamated Zinc and really examining that in quite a different light. And in more recent times, the courts have had this, I guess, this leniency. And really it's, I think that's testimony to the more, I guess, more sophisticated concepts of being in business. So in Jones, for example, in 2002, the commissioner tried to argue that, look, when a business had ceased, going and refinancing the loan that was required to pay off that business would break that chain. And the court said, no, there's no breaking in that chain, in that nexus between income from the business, which had ceased several years prior, and the outgoings, the interest on the loan that was being paid for that, even though they got refinanced. Similarly, in Brown, there was a loan for a delicatessen business in that case, and the courts were also happy to allow that deduction even after that particular business had been sold. So when applying these cases and these principles to our particular set of facts, one should always start with the oldest case, which is the Amalgamated Zinc, where, strictly speaking, after a business ceases, you've got no nexus of 8-1, and Amalgamated Zinc says, look, as a result, look, there's no nexus, there's no deduction. However, there are several cases, and again, the simplest one being that Rompibon tin, where, hey, look, yeah, sure, we ceased business, but we're going to start it again later. The court said, yeah, that's fine, that's okay. But in later cases, they were even more lenient in terms of allowing a deduction there. And so here, certainly, the two cases of Jones and Brown certainly lend themselves towards the taxpayer being able to claim a deduction for increased insurance cover because there is still this nexus, basically the length of time between them, and that connection between the income earning activity and the insurance cover is not broken, it's not severed. And it's also interesting to note that there's something of a trend here. The courts are more and more willing to be able to allow deductions, essentially lengthening this nexus, or lengthening the amount of time that the taxpayer has in order to make deductions even after a business has ceased.